Okay, I'm going to take you through 3 illustrations. Term, universal life, dividend paying whole life insurance. Let's start with term. I have a 34-year-old woman that buys term insurance. My illustration is I'm using a 34-year-old woman for all 3 of these. The term policy she buys, she's spending $600 a year on a term policy. My illustration goes to age 80. So there are 3 different areas to a life insurance policy. There's the cash value, the death benefit, and the cumulative premium, the premium that's been paid in. Now on term insurance, this benefit for her, $600 a year, buys her $280,000 of term insurance. And that will go on until she passes away if she continues to pay the premiums. Now her cumulative premium, $600 a year. As you can see, every year it adds up for the first 30 years, and then most life insurance companies do something that's really interesting. Is on term insurance, as soon as that 30th year comes, they make the renewal offer so ridiculous that most people just drop the plan. Therefore, the coverage just ends and it goes away. So that $280,000 just goes away, and the cash value is 0. There's no cash, no savings. Now, let's look at a 34-year-old woman that buys universal life, spending the same $600 a year. My illustration goes to age 121. So what she's doing is that $600 a year, that cumulative premium, is going into the policy, but now she also has a cash value. The policy's building cash at a guaranteed interest rate, but it's only a portion of the cash value that grows. So it's nice with the universal life is as the cash grows and her premiums change and the market changes over time, because the company, the insurance company, decides the interest rate. That's how they get the cash value to grow. Now the death benefit in this case scenario is $100,000. So it's not the $280 like the term was before, but it's $100,000. But if something happens, she gets the $100,000. If she needs the cash, she can request a loan for up to the cash value amount. Now you have to remember the cash value is still growing. She's getting a loan from the insurance company. So it's kind of like this is a savings account. This blue line is the savings account, and she goes to the insurance company to get a loan. But these funds stay there. Most people don't understand that about life insurance. But that's universal life. So it does what it needs. It's basically a savings account that keeps buying term life. So as long as you keep it funded correctly and keep the funds in there, it grows decent. But we usually use this type of insurance more for the riders, like the long-term care benefit, or the chronic illness benefit, or some other rider that usually is tied to universal life. Next we have, which I feel is the best, is dividend paying whole life. She's still spending $600 a year, and my illustration goes to age 121. Now what's great about dividend paying whole life is the cash value she's putting in. You can see the cumulative premium she's put in, and at age 90 she stops putting in that $600 a year, but her cash value is growing at the guaranteed interest rate 3, 4, 5%. So you can see within 3 to 4 years her cash is now worth more than what she's put in, and it continues to grow. So she'll always have this cash to collateralize against, to go get a loan against, but she also has the death benefit. And because of a contract like this, if you put paid up additions on it, which is a rider that buys extra term insurance with the dividend the company gives to you every year, you can take the dividend in cash of course, then the policy, the death benefit, continues to grow too. So the thing is, we like to show this as a great disability plan or a financing plan. You can finance college, a car, anything through this, and at least it's doing better than any savings account or CD out in the market right now. And it's guaranteed. I mean, these are guaranteed. It's not the market average is 3-4%. It's no, this is guaranteed. That's what's great about dividend paying whole life insurance. Now, most people fall in love with their mutual funds and their other type of investments, which I have as well, and they're great. But one thing I love about dividend paying whole life insurance is as soon as you put that $600 in, your benefit is 100,000 if you pass away. You put 600 into your 401k, you pass away, you only get the $600 back. You don't get the death benefit. Also, that is how liquid is your 401k. This is as liquid as how much cash value you have in there. You'll always get your cash value. So if we look at the mortality table of out of 1,000 Americans, 1,000 people die. Everybody is going to pass away at some point. And you can see where people that buy term when they're 25, to age 65, you can see the life insurance companies, they love selling you term because there's a good chance that they're not going to pay out on it. Most people pass away from 65 to 80, and then from 80 to 100 you have those remaining. The bulk of people pass away between 65 and 80. That is why when we show term insurance, we try to make sure our clients understand that when they buy this in their 30s and they hit 60, 65, chances are they're never going to use that. All that money that has been paid into the term, that $600 a year that keeps that cumulative premium, is just gone away. It's an expense. It's not an investment. It's not a savings. It's not building like the cash value at 3 to 4% a year plus the dividends. These are the best contracts out there, the best for disability, the best for financing a car, the best for financing college tuition. You don't have to put it on a FAFSA report. Think about it. If your cash is growing at 4 or 5% and the company will give you a loan at 5 to 6%, it's a 1% spread on your money. Most banks can't touch that today, and that's why I believe most people do not understand dividend paying whole life insurance. Most people here buy term, invest the difference, but very, very few people do.